What's going on, everyone? It's Smart Cash here. Listen, if you're looking to generate some serious passive income this year, you got to get yourself invested in some solid dividend stocks. And that's what we're diving into today. We're talking about the top 5 stocks out there with the absolute highest dividend yields for 2024. But hold on, before you go throwing all your money into these, we're going to break down each one, talk about the risks you got to watch out for, and of course, the potential rewards. Stick with me, because understanding the ins and outs of dividend investing is key to building long-term wealth. Alright, kicking things off with Company A. And let me tell you, these guys are a major player in the company industry. We're talking brief company description. They have a diverse range of products and services that cater to a wide array of customers, making them a significant force in the market. Now, the first thing that jumps out at you with this company is their dividend yield. It's sitting at a juicy dividend yield percentage right now. That's right, dividend yield percentage. You're not going to find that at your local bank. Most savings accounts and CDs offer a fraction of that yield, making this company an attractive option for income-focused investors. But here's the thing. Before you get blinded by that shiny yield, we gotta dig a little deeper. First off, how's their financial health looking? It's crucial to understand the underlying financials to ensure that the dividend is sustainable. We're talking about their debt-to-equity ratio, their cash flow, and their earnings. A healthy balance sheet with manageable debt levels and strong cash flow is essential. You want to make sure they're actually making money and not drowning in debt, otherwise that dividend could be at risk. High debt levels can strain a company's finances, especially during economic downturns. Next up, let's look at their track record. Consistency is key when it comes to dividends. Have they been consistently paying dividends for years, or is this a recent thing? A long history of dividend payments can indicate a stable and reliable company. Or is this a recent thing? If it's a new development, it might be worth investigating further to understand the reasons behind it. Ideally, you want to see a history of dividend growth that shows they're committed to sharing their profits with investors. Companies that regularly increase their dividends demonstrate confidence in their future earnings. That shows they're committed to sharing their profits with investors. This commitment can be a sign of a shareholder-friendly management team. And finally, we got to consider their market position. A company's competitive edge can significantly impact its ability to maintain and grow dividends. Are they the top dog in their industry, or do they have a significant market share that gives them pricing power and operational efficiencies? Or are they facing some stiff competition? Intense competition can erode profit margins and make it harder to sustain high dividend payouts. A strong market leader is more likely to weather economic storms and keep those dividends flowing. Their resilience and strategic positioning can provide a cushion during tough times, ensuring that investors continue to receive their dividends. Next up, we've got Company B, a company that's been absolutely crushing it in the company industry space. Now, Company B's dividend yield might not be as flashy as Company A's at dividend yield percentage, but don't let that fool you. This company has a dividend history that's longer than some YouTube careers. We're talking decades of consistent dividend payments, and not just payments, but increases year after year. That tells me they're committed to rewarding their shareholders. But past performance doesn't guarantee future results, right? So, let's talk about their future prospects. Company B has been investing heavily in company investments or growth areas, which could lead to some serious growth down the line. And if their earnings continue to climb, you can bet those dividends will follow suit. Of course, there are always risks to consider. Competition in their industry is heating up, and any economic downturn could put a dent in their profits. But overall, Company B's long history of dividend growth and their solid future prospects make them a compelling option for income-seeking investors. Now, let's shift gears and talk about Company C, a big player in the company industry. This industry is interesting because it's known for its stability and consistent demand. People are always going to need products or services offered by the industry, no matter what the economy is doing. And that stability is reflected in Company C's dividend yield, which currently sits at a respectable dividend yield percentage. But here's the thing about this industry, it's also heavily regulated. That means Company C has to play by a lot of rules, which can sometimes limit their growth potential. On the flip side, those regulations also create a high barrier to entry for competitors. So while Company C might not experience explosive growth, they're likely to maintain their market share and continue paying those sweet dividends. When you're looking at companies in this industry, it's crucial to understand the regulatory landscape and how it impacts their ability to generate profits and sustain their dividend payments. Alright, moving on to Company D. And this one's interesting because they've been making headlines lately. There's been a lot of buzz around their recent activities, and it's caught the attention of many investors and analysts alike. Now, before I dive into the news, let's get the basics out of the way. Understanding the foundation of Company D is crucial to grasping the full impact of the recent developments. Company D operates in the company industry, and their dividend yield is currently sitting at dividend yield percentage %. Not bad, right? This yield is a key indicator of the company's financial health and its ability to return profits to shareholders. But here's where things get juicy. The recent news has added a new layer of intrigue to Company D's profile. Just last month, Company D announced recent company news. This announcement was significant enough to make waves across the financial community. This news sent shockwaves through the market, and their stock price jumped. Percentage or dollar amount. Such a reaction indicates the market's perception of the news as a potential game changer for the company. Now, depending on what that news was, it could be a good thing or a bad thing for dividend investors. The nature of the news can significantly influence investor sentiment and the company's future performance. If it was positive news, like a major acquisition or a breakthrough in their research and development, it could mean big things for their future earnings and dividend growth. Such developments often lead to increased investor confidence and a stronger market position. But if it was negative news, like a lawsuit or a product recall, it could put their dividends at risk. Negative events can erode investor trust and lead to financial instability, impacting the company's ability to sustain dividend payments. The key takeaway here is to stay informed. In the fast-paced world of finance, staying updated with the latest news and developments is crucial for making informed investment decisions. Keep an eye on the news, read analyst reports, and understand how any recent events might impact the company's ability to maintain or even grow their dividend payments. By staying vigilant and informed, you can better navigate the complexities of the stock market and make more strategic investment choices. Last but not least, we've got Company E, a company that's been a favorite among dividend investors for years. This company has consistently provided attractive returns to its shareholders, making it a go-to choice for those seeking steady income. And for good reason. Their dividend yield is currently a mouth-watering dividend yield percentage %. This high yield has been a significant draw for investors looking to maximize their returns. But the big question is, can they keep it up? With such an attractive yield, it's crucial to determine if the company can maintain this level of payout in the long run. To answer that, we gotta look at their dividend sustainability. This involves diving deep into their financial health and understanding the key metrics that support their dividend payments. The first thing I check is their payout ratio. This ratio is a critical indicator of how much of the company's earnings are being distributed as dividends. This tells you what percentage of their earnings they're paying out as dividends. A lower payout ratio generally indicates a safer dividend, as the company retains more earnings to reinvest in the business or to cushion against future downturns. Ideally, you want to see a payout ratio below 75%, which means they have plenty of room to cover those dividends, even if their earnings take a hit. This buffer is essential for maintaining dividend payments during economic slowdowns or unexpected expenses. Next, I look at their free cash flow. Free cash flow is a vital measure of a company's financial flexibility and its ability to generate cash after covering its operating expenses and capital expenditures. This is the cash they have left over after paying for operating expenses and capital expenditures. A company with strong free cash flow is better positioned to sustain its dividend payments, even during challenging times. A healthy free cash flow means they've got plenty of money to fund those dividends. It also indicates that the company is efficiently managing its resources and generating sufficient cash to support its operations and shareholder returns. And finally, I consider their debt levels. High debt can be a red flag, as it may limit the company's ability to maintain its dividend payments during periods of financial stress. A company with a mountain of debt might struggle to make their dividend payments if times get tough. It's important to assess whether the company's debt levels are manageable and if they have a solid plan for debt repayment. So, when you're evaluating a company's dividend sustainability, remember to look beyond the yield and dig into those underlying fundamentals. By examining the payout ratio, free cash flow, and debt levels, you can get a clearer picture of whether the company can continue to reward its shareholders with consistent dividends. There you have it, guys, the top 5 high-yield dividend stocks that should be on your radar for 2024. Remember, dividend investing is a marathon, not a sprint. Don't just chase the highest yields. Focus on companies with strong fundamentals, a history of dividend growth, and a bright future ahead of them. And as always, do your own research, understand the risks involved, and invest responsibly. Now, I want to hear from you. Which of these dividend stocks are you most excited about? Let me know in the comments down below. And don't forget to smash that like button, subscribe to the channel, and hit that notification bell so you don't miss out on any future videos. Thanks for watching, and I'll see you in the next one.